Hold on a second. Are you scrolling endlessly searching for that one secret investing tip, that hidden gem stock that's supposedly going to make you rich overnight? Well, what if I told you the most powerful strategies for building real wealth aren't hidden at all? They're actually famous, they're proven, and chances are you're overlooking them. It's a common trap, isn't it? That pull towards the unknown, the feeling that real wisdom must be some closely guarded secret. We're swamped with information, endless new strategies, and the tempting promise of a shortcut to riches. A shortcut that, let's be honest, rarely pans out in investing. Chasing every new thing can leave you more confused than confident, jumping from one idea to another without ever building a solid game plan. But here's the real deal. The core principles of building wealth through investing were figured out decades ago by some of the brightest folks in finance. These aren't dusty old books, they're timeless guides packed with strategies that have actually built fortunes. So today, we're not looking for imaginary treasures. We're diving into the proven wisdom from legendary books that have truly stood the test of time. These are the classics that will help you become a smarter, more disciplined, and a richer investor. Forget the hidden gems. It's time to get familiar with the real treasures. First up, we've got a heavyweight, The Intelligent Investor by Benjamin Graham. Warren Buffett himself said it's by far the best book on investing ever written. And it's been around since 1949. If investing had a foundational text, this is it, especially if you're interested in value investing. So why is it still so crucial? Graham's main idea is actually pretty simple. Buy stocks like you're buying a piece of the actual business, not just a flickering symbol on a screen. He's all about value investing, finding companies whose stock prices are selling for less than what they're really worth. This isn't about jumping on trends. It's about doing your homework and figuring out a company's true value. One of the key strategies Graham gives us is the margin of safety. Think of it like building a bridge. You'd want it to handle way more weight than it'll ever actually need to, right? That extra capacity is your margin of safety. In investing, it means you only buy a stock when its market price is well below what you think it's intrinsically worth. This cushion protects you if you misjudge something or when the market inevitably dips. It's a defensive move, sure, but it helps build wealth by protecting your money and letting you buy more when others are freaking out. It means even if you're a bit off in your estimates, you've got a good shot at not losing money and a great shot at making a profit down the line. Then there's Graham's fantastic concept of Mr. Market. Imagine Mr. Market is your investing partner, but he's super moody. Some days he's wildly optimistic and wants to buy your shares for crazy high prices or sell you his at inflated rates. Other days, he's totally down in the dumps and will practically give you his shares for pennies. Graham's point? Mr. Market is there to serve you, not to tell you what to do. You don't have to react to his mood swings. You can use his irrational behavior to your advantage. Buy when he's pessimistic and prices are low, and maybe sell when he's too excited and prices are high. Understanding this one idea is huge for keeping your emotions in check, which is absolutely vital if you want to become a richer investor. By getting to know Mr. Market, you learn to ignore the daily market noise and focus on long-term value. The key to building real wealth. Common Stocks and Uncommon Profits by Philip Fisher. Next up is Common Stocks and Uncommon Profits by Philip Fisher, which came out in 1958. This book is a great partner to Graham's because it focuses more on the qualities of a company, not just the numbers. While Graham showed us what to buy by analyzing financials, Fisher guides us on how to find really outstanding companies set up for long-term growth. Even Warren Buffett said Fisher had a huge impact on his own investing style, which tells you a lot. Fisher's big idea was about understanding the sides of a business you can't just find in a spreadsheet. He believed the best profits come from finding these amazing companies and sticking with them for the long haul, sometimes even for decades. One of Fisher's most famous techniques is his scuttlebutt method. Think of it as doing some real detective work. Fisher said, "Don't just read the official reports." He encouraged investors to actually talk to a company's competitors, its suppliers, its customers, and even former employees. Why? To get the full story on its strengths, weaknesses, and how it stacks up against others. So, if you were eyeing a tech company, Fisher would say, find out what customers really think of its products, how it treats its team, and if competitors are actually worried about its innovations. This kind of digging helps you find companies with real lasting advantages and great leadership, the types that can grow your investment many times over. It's about getting the story and the whole picture behind that stock symbol. Another key strategy from Fisher is his focus on companies geared for growth, with top-notch management and a serious commitment to research and development. He even laid out 15 points to check for, looking at things like how good their sales team is, their profit margins, how they handle employee relations, and the quality of their leadership. He wasn't just after cheap stocks, he was looking for great businesses that were either temporarily undervalued or whose growth potential the market hadn't fully recognized. This shifts your thinking from just buying cheap assets to investing in companies that are actually building and growing value. And how does this make you richer? Well, finding and holding on to these uncommon companies, the ones that keep innovating and leading their fields, is how massive wealth is often built. It takes patience and belief, based on really understanding the company inside and out. All right, let's talk about Peter Lynch, a true legend who made Wall Street wisdom understandable for everyday folks. His books, like One Up on Wall Street and Beating the Street, are loved because they're so easy to get and full of practical tips. Lynch ran the Fidelity Magellan Fund from 1977 to 1990 and got an incredible average annual return of 29.2% that made it the top-performing mutual fund globally. Talk about results? His main message is really empowering. What makes Lynch's ideas classic is his famous advice: invest in what you know. He argued that regular investors actually have an advantage over the Wall Street pros because we can spot great investment opportunities in our daily lives, often way before they become big Wall Street hits. Think about it. The products you absolutely love, the services you couldn't do without, or the businesses that are always packed at your local mall or that your company relies on. These everyday observations can be the spark for finding great investments. One of Lynch's key strategies is to use your own experiences as a customer or professional to find potential 10-baggers. That's his term for stocks that could go up 10 times or more in value. If you see a new restaurant chain that always has a line out the door, or a new software your company starts using that makes a huge difference, those are clues. Lynch would say definitely do your homework after that. Check out the company's financials, its growth potential, and who its competitors are. But that first spark often comes from what you personally see and experience. This isn't about complicated spreadsheets. It's about being observant and curious. It makes investing feel less scary and more natural, letting regular people use their unique knowledge to build some serious wealth. Lynch also broke stocks down into different categories, like slow growers, stalwarts, fast growers, cyclicals, turnarounds, and asset plays. Knowing these categories helps you adjust your expectations and your strategy. For example, investing in a fast-growing company is different from investing in a steady, established one, and needs a different approach. He also stressed knowing the story of the company. Why do you own this stock? What needs to happen for this investment to pay off? When you have a clear idea of the story, you're in a much better spot to decide when to buy more, when to hold, or when to sell. Lynch's wisdom really takes the mystery out of the market. He shows that by just paying attention to the world around you and doing a bit of basic research, you really can one up on Wall Street and grow your wealth by finding those future success stories before everyone else does. Okay, let's shift to a more recent book that's already considered a must-read: The Psychology of Money by Morgan Housel. While the other books mostly talk about how to pick investments, Housel's fantastic book looks at something just as important, but often ignored: the behavioral side of building wealth. It's not just about what you know, it's about how you behave with your money. He uses great stories to show that financial success is often less about complex math and more about understanding our own biases, emotions, and habits. One of the biggest eye-openers from Housel is that good money management has very little to do with how smart you are and a whole lot to do with how you act. You could be a financial whiz with all the data in the world, but if you panic and sell when the market drops or get caught up in hype, you're probably not going to do well. On the flip side, someone with average financial know-how who is disciplined, patient, and consistent can build serious wealth over time. And that's great news, because our behavior is something we can all work on. Housel talks a lot about being humble, admitting we don't know everything, and how important it is to simply avoid big mistakes. Getting rich And even more importantly, staying rich is often about just staying in the game. It's about having a financial plan that lets you sleep at night so you can actually stick with it, no matter what the market's doing. Another key idea is the difference between being rich and being wealthy. Being rich might mean a big paycheck or fancy stuff. Being wealthy, though, is about financial independence, having assets that aren't spent, that can create future income and give you freedom. Housel really highlights the power of saving, not always for a specific big purchase, but just for the sake of saving. This builds a cushion that gives you options and helps you handle life's surprises. He also talks about luck and risk. We love to think success is all skill, but luck often plays a bigger role than we realize, and risk is always there with it. Understanding this helps keep us humble and not too cocky. For Housel, the road to getting richer is really about good psychology, understanding how greed and fear affect you, choosing long-term consistency over quick wins, and figuring out what enough really means for you. These behavioral tricks are like the hidden engines that power real, lasting financial success. So that's a wrap on these powerhouse books. Instead of constantly hunting for the next hot tip or some mythical hidden gem, the real way to become a richer, smarter investor is by soaking up the timeless wisdom in these classics. We've covered Graham's solid ideas on value and having a margin of safety, Fisher's methods for finding excellent businesses, Lynch's practical advice to invest in what you already know, and Housel's essential lessons on the psychology of money. Together, they give you a pretty amazing roadmap. The strategies they all talk about, like thinking long-term, doing your homework, keeping your emotions in check, and really understanding what you're investing in. These aren't secrets. They're proven core ideas that have helped the most successful investors for ages. The best part? Their wisdom is out there for anyone, and these lessons can genuinely change your financial life. Building wealth isn't about finding a magic trick. It's about building a strong base of knowledge and then using it consistently. So which of these classics have you already tackled? Or which one are you thinking of grabbing first after this? Let me know your thoughts in the comments, and definitely share your own favorite investing books too. What's that one book you think everyone should read? If you found this useful and want more straightforward advice on building wealth and getting a handle on your finances, do me a favor, hit that like button, subscribe if you haven't already, and click the notification bell so you don't miss what's next. Thanks for watching, and here's to becoming a smarter and hopefully richer investor by learning from the greats.